All right, let's dive right in. Today we're going to do something I think is pretty cool. We're putting on our lab coats, metaphorically speaking, to give a company a full financial health checkup. We're going to learn how to look past all the flashy advertising and the cool products to see what's really going on with a company's numbers. I mean, have you ever really thought about it? A company can have a fantastic reputation. Everyone loves their stuff. But just like a person, its true health, well, that's hidden beneath the surface. We're about to get the tools to pull back the curtain and see what's actually happening behind the scenes. Okay, first things first, let's get a couple of key ideas straight. Accounting versus finance. They are not the same thing. The easiest way to think about it is this. Accounting is the scorekeeper. They are meticulously recording every single thing that has already happened. Finance, on the other hand, is the team's strategist. They take all that historical data and use it to make smart decisions, to plan the team's next move. So one looks back and the other looks forward. So to start our checkup, we need to see what's going on inside the patient, right? In finance, our version of an X-ray is a company's 3 core financial statements. These are the documents that are going to tell us the true story of a company's financial life. Here are the big 3. First, you've got the balance sheet. This is like a photo, a single snapshot of the company's financial position on one specific day. Next, there's the income statement. Now, if the balance sheet is a photo, the income statement is like a video. It shows performance, all the sales and expenses, over a period of time, like a quarter or a full year. And finally, and this one is so important, the cash flow statement. It tracks the actual real-life cash moving in and out of the business. All right, let's pick up that first X-ray and take a closer look. We're going to dissect the balance sheet. It's built on a really fundamental idea that shows us the company's core anatomy, and it's made up of 3 parts: assets, liabilities, and equity. First up, assets. What are they? Simple. It's all the valuable stuff the company owns. Think back to our doctor analogy. The doctor's assets would be the office building, the expensive X-ray machine, the cash in the bank. Basically, everything they use to actually generate income. But, and this is a huge but, the type of asset changes everything. Let's take inventory. For a company like Häagen-Dazs, their inventory is ice cream. People are always going to buy ice cream, right? It sells pretty reliably. Now think about Best Buy. Their inventory is a warehouse jam-packed with TVs. In the world of tech, those TVs could be obsolete in a flash. That makes their inventory a much, much riskier asset. Okay, next up we have liabilities. This is the other side of the coin. If assets are what a company owns, liabilities are what it owes. It's all their debts and obligations. A super common liability is called accounts payable, which is just a fancy term for bills from suppliers. For instance, Intel sells a bunch of computer chips to Dell on credit. Well, until Dell pays that bill, that amount is a liability on their books. And that brings us to the last piece of the puzzle, equity. This is what's left over. If you took all of a company's assets, sold them for cash, and then used that cash to pay off all of its liabilities, the money that's left in the pile, that's the equity. It's what the owners and shareholders actually have a claim to. It's their stake in the game. So we've examined the company's anatomy. Now it's time to check its vital signs. And in a financial checkup, our stethoscopes and blood pressure cuffs are financial ratios. These are some really powerful and usually pretty simple calculations that help us diagnose a company's health. And these vital signs fall into 4 main categories. Think of them like 4 different tests a doctor might run. First, liquidity. Can the company pay its bills tomorrow? Second, activity. How efficient is it at using what it has? Third, leverage. How much debt is it relying on to operate? And finally, profitability. The bottom line. Is it any good at making money? Let's start with liquidity, because this one is all about short-term survival. The question it answers is simple. Can the company pay its bills that are due soon? A really common ratio here is the current ratio. It compares short-term assets to short-term liabilities. Generally, you want that ratio to be over 1, which means you have enough to cover your bills. But, most analysts get a lot more comfortable when they see a number closer to 2, just for that extra safety cushion. Okay, next up, activity ratios. These are all about efficiency. How good is the company at using its resources? For example, inventory turnover tells us how quickly its products are selling. A high number here is great. And accounts receivable turnover shows how fast it's collecting money from its customers. If that number is too low, it's a huge red flag. It means the company isn't getting its cash fast enough, which can literally starve the business. And all of this efficiency stuff comes together in one incredibly powerful metric, the cash conversion cycle. This measures the time in days from when a company pays for its inventory to when it finally collects cash from the sale of that inventory. And get this, Some super efficient companies, like Amazon, actually have a negative cash conversion cycle. This means they get your money for a product before they even have to pay their supplier for it. It is an amazing position to be in. The shorter the cycle, the better. So we've covered the basics. We've done the general checkup. Now it's time to call in the specialist. And in finance, one of the most powerful diagnostic tools you can use is called the DuPont analysis. This is how we find out what's really driving a company's performance. The entire DuPont analysis centers on this one key metric, return on equity, or ROE. For any owner or any shareholder, this is the bottom line number. It answers the most important question. For every single dollar I've invested in this company, how many cents of profit is it making for me each year? It's the ultimate report card. And here is the real magic. The DuPont framework takes that big ROE number and breaks it down into its 3 core ingredients. Is the company generating a high return because it has fantastic profit margins? Or is it because it's just incredibly efficient with its assets, which we measure with asset turnover? Or is it using a lot of debt, a lot of leverage to juice its returns? This tells us why the ROE is what it is, not just what it is. Our checkup is almost complete. We've analyzed the past, we've diagnosed the present, so what's the final step? Well, it's to look ahead and think about the prognosis. And this is where financial forecasting comes in. Look, financial planning isn't about having a crystal ball. Nobody can predict the future. It's about being prepared for different possibilities. So, a smart company will map out an optimistic scenario, where sales are booming and everything's great. But it also needs to plan for a pessimistic one. What happens if a recession hits or a new competitor comes out of nowhere and totally disrupts the market? And that, right there, is the ultimate goal of this entire checkup. By understanding its current health and by stress testing its plans against different possible futures, a company can build a strategy that's smart and, most importantly, resilient. It can prepare for the storm so it's ready to thrive no matter what happens. So there you have it. That's our complete framework for a corporate financial health checkup. We've gone from the basic X-rays to the specialist diagnosis, and now the tools are in your hands. So the only question left is, which company's health will you check first?